Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is operational risk considerations under the US Basel Endgame proposal. My name is Jeff Taft, and I'm a co-head of Mayor Brown's Financial Services Group in our Washington, D.C. office. Joining me today is my partner, Matt Bisanz. Matt is a bank regulatory partner also in the Washington, D.C. office. With that said, let's begin. At this point, no overview or background is needed. Undoubtedly, all of us are working in some way, shape, or form on comment letters to the Basel proposal, either through our trade associations or through our institutions. Today's program is part of our ongoing series on the Basel Endgame. We've started with a high-level overview and then have drilled down into potential impacts of the proposal on various areas, including securitization, capital markets, the mortgage market, and commercial real estate. More recently, we covered market risk and some of the key recurring issues raised by clients in that part of the proposal. Today, we are going to discuss operational risk. In my view, this is probably one of the most overlooked areas and something that will present challenges to any covered institution. As we will discuss, the challenges are broadly twofold. First, you have the capital charge associated with operational risk. But second, and potentially more challenging, you have to put in place tracking and reporting requirements in order to understand what your obligations and create the infrastructure necessary to actually figure out what operational risk you need to have a capital charge against. With that said, let me turn it over to Matt, who's going to kind of kick us off here. So Matt, what is operational risk and why is it such an important topic for our listeners?
Thanks, Jeff. That operational risk is under the Basel standards and under the U.S. proposal defined as the risk of loss from inadequate or failed internal processes, people, systems, or from external events. And that's a mouthful that I like to redefine as bad things. That a teller steals money out of the cash drawer. That's an operational risk event. Hacker takes down the ATM network. That's an operational risk event. God forbid, bank branch burns down. That's an operational risk. So it's really a wide range of things that the Basel Committee's definition is broken into 7 subcategories, including things like internal fraud, employment practices, damage to physical assets, process failures, and really that definition goes back to 2001 is the last time the Basel Committee updated it. The reason why most of our listeners probably have not been focusing on it until now and why it's becoming more important is that in the U.S., only the 10 or so largest banks had to separately track and capitalize operational risk, that the U.S. took the position that operational risk was implicitly included in credit risk for all of the other 4,800 U.S. banks out there, and so those banks didn't need to track it. But as we're going to talk about today, that is changing.
I guess one question I had, and we've talked about it a little bit internally, but why do you think the regulators picked now to make this a prominent standalone part of the capital rules rather than just kind of leaving it as it had been previously?
I have a few theories, some probably more valid than others. I think one is that the US Basel Endgame proposal is designed to implement the Basel Committee's 2017 revisions to the international standards, which included some operational risk changes. And so the US has in many ways almost without even thinking about it, adopted what the Basel Committee said. there are places where we've added more punitive elements, but for the most part, we've adopted what the Basel Committee said, or we plan to. Also, the U.S. regulators have a decade-long movement against allowing internal models for capital charges. And right now, for those 10 largest banks, they're allowed to calculate operational risk capital using internal models. And so putting in place a proposal that makes everyone use a standardized non-model approach is really consistent with where the regulators are going. And then I just think that some of the prominence in recent years of operational loss events at banks, be they things, settlements for AML and sanctions violations, issues with wire transfer fraud and other types of business email compromise. There just have been so many headline-grabbing operational loss events that it's easy to convince a regulator they need to do something more.
What's interesting, I think when we talked about credit risk, initially, I think everybody's kind of familiar with credit risk. They kind of understand how the capital charge works for credit risk. Last time around, we talked about, market risk, which I think is a little different. I think obviously calculating the capital charge on market risk is quite a bit more complex and different than credit risk. Maybe talk a little bit about how what capital charge for operational risk would work, because I think that's obviously an important element so that people can understand how challenging this may be.
Well, thankfully, the math is easier for this. That the math for market risk, I certainly can't do it, and I think it's probably beyond even many investment bankers to do the math for market risk. But for operational risk, the math it's longer, but it is something that a humble lawyer here can do. That it's a formula. It has several elements to it, but they are all multiplication elements or addition, which again makes life easier for someone like me. Within the formula, there are, I'll call them drivers for the numbers that we're multiplying. One of the included numbers is based on the volume of a bank's business from interest revenue, services, income, and expenses, and revenue from trading activities. Another one of the factors is the bank's overall volume of business activities, that this is a kind of a multiplier to convert it into something that can go into a capital table. And then the third factor is a multiplier that adjusts for the bank's own historical losses. But again, this is a pretty complicated formula. It is something we have modeled internally. BPI also has some spreadsheets they've shared that shows how it is expected to affect the 40 or so banks who are covered, and most of it actually can be pulled from the call reports.
Interesting. I mean, it does sound complicated, but then again, to a lawyer, most math sounds complicated, right? That's why we went to law school. Yeah. How does the volume of the various business activities affect the calculation, and how does that play into this?
Yeah. So this is one of the interesting and more controversial elements. That like I said, you're counting interest, income, you're counting revenue from services activities, and you're counting total trading activity. And so for interest income, it's just that. You look at a bank's interest income, its dividends, other types of net income, and it's capped at a certain percentage of that. Trading activities, somewhat rare at banks, but similar figure. Services income is where it gets interesting, because a bank includes the total income or total expenses from fee-based businesses, whichever is greater. Typically, it will be fee-based income or fee-based revenue. And so this includes things like commissions from securities brokerage, safe deposit box rentals, interchange earnings from credit card activities, commissions on annuity sales, fees from ATM machines, really anything that isn't an interest driver. And unlike the interest and trading activities, this services or fee-based revenue, it's uncapped and it's done on a gross basis. So this formula, there's a footnote in the proposal that explains where you look on the call report, and you can actually, for the most part, add it up, and it ends up for some banks being quite a large number.
There's also the historical loss multiplier that I think that you identified as we were kind of highlighting the requirements at a high level. Maybe talk a little bit about that. Also, though, we've heard a lot of people talk about this proposal that the U.S. banking regulators have adopted being a little bit more stringent than the Basel proposal itself, and maybe some discussion around that. I know that's something that a lot of folks here are focused on, but obviously folks at the agency and folks within the institutions themselves have kind of pointed to this.
Yeah, that's a good point. That so the first piece that we've been talking about with all of these revenue and income numbers, that really is a standardized reflection of the volume of business a bank does, which the regulators say is a proxy for how much operational risk it has. But then the regulator said, well, we want to adjust that, though, for a bank's actual historical operational risk experience, recognizing that you may have a large bank who is good at managing operational risks, or a small bank that is bad at managing operational risks, and that should be included. So the proposal has what's called the internal loss multiplier, and it's its own formula that is based on the last 10 years of a bank's historical operational losses. And this is where, when you said at the beginning, the information collection for banks is going to be painful, that under the proposal, banks would be required to identify and track every operational loss they incur over the prior 10 years if it exceeds $20,000, and they have to quantify it. So they have to figure out how much did this loss event in the net count. So like say, again, going back to the ATM hacking, well, like we had the ATM was hacked. We had customers who were unable to access their accounts. They might have requested refunds for things. We had to maybe pay a ransomware coverage. Only part of it was covered by insurance. Here's our net insurance recoveries, and add all of that together just to quantify that one cyber incident. And so a bank has to track that over the prior 10 years. And the formula reduces it down to a number between 0 and effectively 0 and I'll say 2, but 0, it's centered around 1. And if a bank has had a lot of operational losses, say it's poor at preventing them from occurring, the internal loss multiplier will be greater than 1. And so that even though the bank's size is a factor, that then we're increasing it to reflect the poor operational loss history. Under the Basel Committee's under their standards, the number can go below 1. That if a bank is really good at preventing operational losses, if it looks over its 10-year history and the formula shows that it has done better than you would have expected, its multiplier can go below 1, and so it actually will have a lower amount of capital. In Europe and the UK, they are taking the approach of saying, this is a huge operational burden, pun intended. We don't want to put this on banks right now. We're going to set our internal loss multiplier for our European banks at 1.0, just make it a non-factor. Like I said, Basel said you could either get a number below 1 if you're good, or a number above 1 if you're not so good. In the US, the proposal takes the most punitive approach and says, we are flooring the internal loss multiplier at 1, meaning that if you are a perfect bank, you have managed your operational risks over the prior 10 years in a pristine manner, you have an internal loss multiplier of 1.0. If you have done a terrible job, you've had lots of settlements with the government, you've had lots of people stealing money, etc., then you can go above 1. And so it would really be a punitive tracking for the internal loss multiplier.
It's interesting. So, I mean, again, you have a situation where U.S. banks' best case scenario would be flat or equal with their European colleagues. So, obviously, this is another one of those examples when you look at the proposal that could put U.S. institutions at a little bit of a disadvantage. Because obviously some of them may be equal, but others obviously are going to be worse off compared to their European colleagues. That's one potential issue, I guess, with the operational risk part of the proposal. But what are some of the other things we've been hearing around that? I mean, I know we've had a bunch of conversations with clients about it, but maybe just try to highlight a couple of the bigger issues for folks.
Yes, I want to come back to the inclusion of services revenue in the volume calculation, because that's something that Jamie Dimon had a really good quote that I have stolen for my use. It's are all revenue equally bad? Really? What person in what ivory tower thinks that is a rational thing to do? And he was getting at the point that all fee-based income counts the same toward the volume factor. So a bank might have some revenue that comes from a fairly low, an activity that's at a low risk of incurring operational losses, or at least where the risk doesn't vary based on volume. Say something like credit card interchange fees, that it doesn't really matter how much a bank scales up its credit card operation. It still comes down to the what is the rate of failure on the network, what is the rate of input, that it doesn't really scale, versus something like maybe investment advisory services where, yes, the risk does scale up over time, that if you keep adding more and more investment advisors, each one of them brings their own risk of non-compliance or their own operational risks to the table. And so he's pointing out, why are we treating all of these fee-based revenues the same? And in particular, the fact that it's an uncapped amount, that it can really be a hugely punitive number. The U.S. proposal also takes a few approaches that some of the trade associations have flagged with the calculation of that fee-based income, where the U.S. has either a more punitive or punitive approach. One is that the revenue is measured on a gross basis, typically either the higher of your revenue or expenses. And so this results in some accounting issues, that typically revenue will be greater than expenses, but some expenses actually match up nicely to revenues. And think, if a bank is passing through fees, like maybe a bank is providing clearing services, and so it passes through fees from a clearinghouse to customers, and from the bank's perspective, it's paying an expense to the clearinghouse and then earning a revenue from the customer, but it still isn't offsetting those because it's to two different parties. And so that revenue from the customer will count entirely against the bank on a gross basis, even though the bank knows it has to put out pretty much almost the entire amount to the clearinghouse. And so that whole net versus gross basis, particularly for passed through fees and expenses, is a pain point. Another one is that the U.S. leveraged the FRY9C categories for the most part for identifying services income, and it included in there some items that are explicitly excluded from the international standards, the most notable of which is insurance underwriting fees and commissions. Banks don't do a ton of that as just a market practice, but it is one of those points where the U.S. has taken the most punitive approach.
I think one of the interesting things about it is the whole focus on fee income, obviously. If you go back to the financial crisis, and obviously I was old enough to be around there, so I remember it well. I think a lot of banks moved away from the crisis with a goal of generating more steady fee income, getting away from some of the other volatile sources of income and moving into areas such as asset management and other areas that generated, regular steady fees. Now, fast forward, 10, 12 years later, and that fee income is now the basis for a capital charge, which is kind of, punitive in the sense of, they were kind of both voluntarily and steered there, I think, a little bit by the regulators, feeling that that was a better source of income, having fees and stuff, and now finding themselves subject to this, what could be a relatively punitive capital charge, and not only a capital charge, but also, punitive methods of having to calculate and capture this data. So I think it's very interesting how we've kind of come a little bit full circle now. People may be getting out of the fee income business. They may be jettisoning some of these businesses. Now look, not everybody had great success in asset management, but certainly a lot of people went into it. And there are certainly other areas that I don't think are quite as easy to get out of. But you may see some of that going on in the future.
Yeah. I think there's also, I agree completely, but I think there's also an issue with correlation that when you look back to the prior crisis, you can say, well, look, there's some correlation between credit and market risk, that if people are defaulting on their mortgages and auto loans and stuff, and it's being at a widespread level in the economy, then it makes sense that stock prices also are going down. And so maybe it makes sense that banks have to hold separate amounts of capital against credit risk and market risk. That's what you saw in the last crisis. But I was still in law school at the time, but I don't remember there being an unusual spike in hacking or bank branches burning down, that it just didn't seem as correlated that there are operational losses that would be increasing simply because there was a declining economy. And capital's fungible, that like the money a bank has, that it's earned through capital, either through retained earnings or stock sales, that's fungible. And if the bank can use it to mitigate credit losses, why couldn't it say, well, this year I'm going to use it to mitigate credit losses because the economy's bad, and next year I'm going to use it to mitigate operational losses because maybe, say, there's a war in Europe that's drawn the attention of hackers from certain unfriendly countries. There's really no correlation, so why should we be putting them into separate buckets?
Yeah, and along the same lines, I guess this kind of goes to the point we've hit on a little bit, but there are going to be some kind of secondary issues that arise here that institutions are going to have to be thinking about, probably well in advance of this becoming a final rule, if we get to that point, obviously. But some of those things that they should be thinking about when they're thinking about not only the capital charge, but again, calculating, maintaining the data that they have, and there'll be some challenges. But I mean, what have we been hearing from people so far?
One of the nuanced points that I think will affect some of our transactional colleagues, or at least will yield a lot of questions for you and me when we have deals brought to us, is that the proposal says that if a bank buys or acquires an entity, that it either needs to pull in that entity's operational loss history or use certain formulas to account for the fact that it now has acquired this new source of operational risk. And I think there can be some fairness to that point. It still is debatable, but like that makes sense. The proposal, though, is silent on what to do about asset or business line purchases, where you're not buying an entity, but say maybe you're buying a loan portfolio. And the thought has been, well, these should not be subject to a historical look back, that there's really no way you can bring over that historical loss data from assets. But that could result in some deal restructurings where if you have the option to buy only the assets from a business, you might prefer to do that instead of buying the entity, because you don't want to bring over that entity's historical losses, particularly maybe if, say, that entity has had a lot of settlements with the government or a lot of litigation losses, that you don't want to bring over that loss history and put it in your books. And so you might want to explore asset purchases.
Yeah, an interesting point. I mean, I think there are a lot of things people are going to need to consider besides the capital charge, obviously that's associated with it. Just like with, credit risk, which I think historically institutions have kind of gotten comfortable as to how to mitigate that risk and how to mitigate the capital charge there. I think they're going to have to look at operational risk in a similar manner kind of going forward, and making sure that they have the data and the information they need It could preclude you from doing acquisitions, or it may make acquisitions more expensive. So I think that's a very good point. I think we're kind of hitting our limit here. So I think I want to thank you, Matt, and thank you to the audience, our listeners. Listeners, if you have any questions about today's podcast or anything else related to the global financial markets, please email us at gfm@mayorbrown.com. Thank you.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.